You can start. Okay. Basically, I think can someone at least put in the chat box what did you all learn? The last lesson you learned with respect to this program course. What is the lesson that you all learned? What area, I guess? Is it project management, HR, business? Or remember, or we can't remember? Strategic management. Great. Okay. So what we are going to learn in next couple of weeks, that's about portfolio management. That is portfolio management and the risk management. So one of the very important area in the banking sector, but very often the majority of the bankers won't get to exposed to these areas because majority of the people are either in the operations or the business. So then only it's a kind of a business banking industry. So as a result, the people who work in the bank actually don't get exposed to this area, portfolio management and risk management. There is a head office level, very significant and important departments are handling that. These are the top level senior management is appointed to these departments, and they are running the show. They get involved in policy level decisions. So then what is in it for you all? Maybe you all are starting your at the early stage of your career, or maybe getting into the middle of your career. So what's the significance of these areas to you? So one thing is you're also getting ready for an exam. Or you also need some qualifications to show, so that under this program you need to get qualified, right? Get through the exams. That is one area. So more than that, what I'm saying is these are the areas that if you really want to become a professional in your career in banking, if you want to be a real professional banker, you need to get in touch with some of these areas that we are talking about. So these 3 weeks, the content that I am going to cover will not necessarily cover what you want in your life, but this is a kind of a background, the foundation, so on which you all can build on, right? So, but one little thing that I have seen over last maybe year or so, what we are going to learn today, some of these are now you can hear and see in the news items also. Or if you are a banker, maybe some of your colleagues, relatives might have questioned you. So I am a general layman, you are a banker, or you work in the finance industry. So I don't understand this dollar. There is a crisis. There is issue with the bonds and all. So I don't understand. Can you explain it to me, right? So this is kind of a eye opener, and also give these 3 lessons give you an understanding what exactly uh, actually led to these crises. Maybe it could be foreign exchange crisis, or the bonds issue. We have a debt crisis also. So there are 2 different things, but ultimately these things get connected, right? Interlinked. So possibly you get answers to these questions also, and I hope if you read through it after our discussions in the class, you have a hang of it, and you also can uh, probably with confidently explain it to another person. So if you can do that, I think that's what expected. In addition to you are getting through these exams and also uh, learning something about it. If you can, getting some knowledge on this, and if you can explain it to somebody, if you confronted with some kind of a question from outside party, another, I think, area that you can be happy about, right? So this is what we are talking about. I'll In a while I'll let you know exactly what we are going to cover during these couple of weeks, and also how I'm going to conduct this lecture is basically I have a presentation, PowerPoint presentation, and also since like I said, at the outset, so this is not an area, so you are getting very frequently. So if you in the work in the front end office or maybe credit operations, you don't get to know exactly what these head office people doing. So I have selected very few videos, so to let you know what exactly these people, head office, get involved, their maybe lifestyle. Maybe if who knows, you also get get attracted to some kind of to play a role or get into these kind of play a job or do a kind of a function. So if you get interested in it, and if you want to further enhance your career in these areas, you can take some other courses, right? So we are basically uh, talking about Treasury Department. If you want to get into Treasury Department, you need to know there are dealers, chief dealers, right? So you need some kind of a different kind of a qualification, right? Rather than this diploma level qualification, you need at least CFA kind of a qualification plus some other licenses, central bank level licenses, and maybe a treasury institute of the chartered level institutes giving licenses for dealers. So those are the some, if we really want to get into work in this department, this is what you got to do. Right. So with that, let's move on to what our area that we are going to cover maybe today. And so if there is anything left over, we'll have to take it over to the next week and then to the other week as well. So like I said, these are the areas that hope you can see the presentation. And so let me briefly tell you what exactly we are going to cover under each of these areas, right? So bank and treasury department. So we introduce. So what is the relationship, right? So treasury department, what their role is all about, right? Functions of treasury department, like you in the credit, maybe you are doing credit evaluations and disbursements and recovery follow-up operations. Likewise, treasury department also has certain very specific functions, very important functions, right? So we are going to touch upon that as well. And uh, again, basic concepts in fund management. Treasury is all about managing our funds, bank level funds. They need to uh, source funds, get funds for credit people to lend it to outside, right? So they basically work with the fund management, right? So then there are, so in what form these funds are available, right? So there are fixed income portfolios, right? So bonds, when it comes to fixed income portfolios, it represents or consisted of bonds, treasury bills, and things like that. And again, then we learned under this concept a little bit of details about these bonds and treasury bills. We in fact learn to calculate the price of a bond and a treasury bill. And again, stock markets, so also another area. There are, certain banks have, investments in other investments in the stock markets also, at least uh, minimal level. So that is not the bank's core business is, taking deposits from the general masses and, you know, act as an intermediary and giving it to the lenders outside. But uh, in to a certain level, they get involved portfolio management at treasury level, and also there is a buy and sell in stocks also, right? So very limited. That's not the core business, but they get involved in that kind of a area also. As a result, uh, people in the treasury department, they have some understanding about the techniques, the concepts. They are very thorough about how to do it. This is a very specialized area. And then again, asset allocation strategies. So what type of assets in what quantities that we need to keep, right? How much of bonds we need to keep, percentage wise treasury bills, because we need to uh, have our liquidity level at a satisfactory level, and also how much of lending that we need to do, how much of deposits, again under deposits, how much of CASA we have, right? How much of equity at bank level, uh, and profits converted to equity each of the year. So head office level, treasury need to uh, take some decisions and maintain some ratios just to make sure banks actually running in a good shape. So finally, we'll talk about risk management. Overall, I think what are the main risks of the bank. Can someone put in the text chat box or text as a text? What are the main risks uh, banks are exposed to? So any moment you can either put it in the chat box. So what are the main risks that you know about that banks are exposed to? Operational risks, right? Great. What else? You're talking basically credit risk, right? Two more at least. Two more major things: operational risk, credit risk. Liquidity risk, Ishan. Yes. One more. Market risk, right? So, but if you put it in a different order, so but the highest level exposure is in a bank is for credit risk, but because credit is our main business now, right? Credit is the risk is the highest risk, and to a certain extent, I think then comes liquidity risk, because banks need to function, and for that the fund flow from depositors to lenders recoveries to up again depositors, that the fund flow should be in a very optimum level. If that goes off, banks won't be able to function. So I would say the second most important risk is liquidity risk, and then again the market risk, right? And again, the last one is operational risk. But there are the other areas of risk also. But these are the main risks that bank level that we discuss, right? So then finally we discuss about after uh, getting to know a little bit about this risk types of risks and ways of managing risk. So we learn about, at bank level in the financial industry, there are in the historically had, ups and downs. So we try to learn about one of the major up and downfall in the financial industry in somewhere in 2008-9 period, global financial crisis, right? Uh, so there is a small case study that we you all get to read it, and so then we'll try to discuss that and try to understand what exactly happened. This is what basically that we are trying to cover, and so we'll start uh, going to one of these, and one by one we'll try to roll it over, right? So like I said, so what is the connection, right? So we have, credit department, treasury department, operations department, legal department, IT department. There are so many of departments in the bank, right? So, so all these departments, if you take a bank level organization structure, a CEO is the main person, but on top of CEO, there is a board of chairman and the board of directors. So board of directors and the chairman, as you know, they decide on the policy level, strategic level, direction they give, and the CEO and the senior management has to run the show, and then report it back to the board. So that's how it works. So basically, this is the structure. So since this is little new to us, right? So this will be, like I said earlier, we are learning a little bit more about Treasury Department, and Treasury Department, in fact, directly reporting to CEO, and also there is very good, important board level reporting to Treasury head, also reporting to board also for directly for certain other issues, right? Maybe fund level decision making. Treasury head has access to board also, right? So because sometimes to take decisions, very important decision fast and take informative decisions, so that freedom has been given to the head of the treasury. So some of the main functions of uh, the treasury department is, so they need to handle all the foreign exchange related work and money market dealings, right? So money market dealings in the sense, again, fixed income securities, right? Treasury bonds, treasury bills, and things like that. So if there is any, there are derivatives. There are so many derivatives in the finance industry. There are, you probably heard of the SOPs, right? So you must, so the easy thing is, you so about 2-3 years ago, when we say SOPs, students, that's a very word that unheard of, but SOPs right now, it's you can hear that this in very much in news, because we have in the debt crisis, we get SOPs from Bangladesh, we get SOPs from India, right? So that's kind of a SOP, right? Uh, so we'll learn about what exactly SOP is. So, but here we identify that as a area that treasury get involved. So many other options, forward contracts, right? Futures. These are some of the names or products, finance industry, banks handle, but Sri Lankan banks handle it at a lesser level. But investment banks, if you have investment banks, so they handle it to a larger extent. But normal commercial banks, they don't expose to these derivatives to a great extent, very little, if at all. So they need to manage the liquidity right? So they need to look at our CASA balances, liability balances, and so how much the forecasted disbursements, so other the payments or settlements to other kind of financial institutions, right? So at which point we need to raise funds, issue debentures. So these are some of these areas that they need to look at, right? Again, central banks also monitoring liquidity levels of the banks, right? So there are some controls on that. So in that, with regard to that, banks have to maintain certain ratios, statutory reserve requirement management. In that sense, is also so one of the main areas of Treasury, right? Statutory reserve ratio is of the total deposits. Banks need to keep a certain percentage with the central bank, right? That's a statutory reserve ratio, right? Then the local and foreign currency cash flow management, right? So we know we are handling international trade, right? There are banks issue letter of credits, right? We get export, proceeds from other countries. Maybe we export tea, right? So we get export from our exporters, buyers. We get funds, so we need to. So banks need to manage those incoming and outgoing foreign currencies also, and then the asset and liability management. Assets are the assets are basically the loan products, right? uh, from which funds are going out, and again liabilities are the deposits, right? So we need to manage these assets and liabilities, so in order to uh, have a smooth functioning, and also to manage at a liquidity at a very satisfactory level, right? So for asset and liability management, there is at bank level. I think credit side, you must have heard the credit committee is taking the top level credit decision, and then if there is any requirement, they will recommend it to the board of directors. But when it comes to asset and liability management, there is another committee at senior management level. So can someone, just to break the monotony of this discussion, to make it both ways, what is the committee at senior management level looking at assets and liability and pricing of both the deposits and the loans? What is the department? What is the committee handling that? Can someone say? Have you heard of ALCO? ALCO committee, Asset and Liability Committee, right? Again, CEO and top level senior management, who in fact Treasury head is also there, couple of his colleagues, and plus the business level who is running the show in the credit side, right? And maybe head of lending, head of deposits mobilization, head of operations, right? So these consisted of the senior level, COO, CEO, right? Head of treasury, head of maybe lending. Uh, so these are the people and their staff, you know, taking different proposals. They taking uh, research done on maybe the latest industry trends in the pricing of assets and liabilities. how the other banks price the rates of deposits and then again the loans. So they take all this into account, and the fund level, what are the available balances, the CASA level. So taking all this into account, uh, senior management take some decision with regard to pricing, and also if there is any funding requirement also they take decisions, right? So then so we just go into little detail how at treasury level they are going to they function, how they function. So if you take the treasury department structure, they're again like our normal banking. They have front office, the middle office, back office, right? And the front office people. So let's see, these are the two main areas. So what are the main things that people in the front office do, right? So basically, the staff in the front office, like in maybe in our front office also, people, if you take the bank, people who work in the counters are the people who are in the front office in our main frame banking, right? Treasury, the front office staff are the dealers, right? So these are the people who work with the outside parties, right? Maybe other banks, dealers, and maybe other fund managers, right? So many of outside parties, internal and external, right? So basically, they have a profit target. Need to raise funds at a cheapest possible cost, and they should allow the bank to make profits by uh, letting the bank senior management to take these decisions to price their products at a comfortable level, leaving banks a profit, right? So so by nature, the dealers assume market risk because so, so the price right now, maybe the rate that they borrow can change in a while. So they need to decide on which direction these rates are going to move, right? They need to take the call at the right time. If it maybe up late by a couple of minutes, the rates can go up. So as a result, bank level costs also go up, right? So as a result, I think they need to be very smart and also very should be able to take decisions on their own without referring to senior people and always. So dealers are very independent and people who are with some autonomy to take decisions. So they are expected to take risks on behalf of the bank, but they can't mess it up, right? So if they mess it up, so that's the end of the story. So uh, for you to understand, so in our front office, you know, they also deal with the cash, right? So they are expected to go and at frequent intervals keep the cash in the walls and things like that. But certain people, must be also aware of short. Certain times their cash is short and get into trouble. So what happens if they are found out very frequently mishandling cash? They are actually losing their positions, right? So then, in fact, bank management take a decision, branch level manager or someone take a decision to replace him. So similarly, so although these dealers are expected to take risk, if they mess it up, so they need to be replaced much faster than the people who are in the counters, because these people are making huge of impact. So the transactions are in billions. If they make a mistake, so losses are also running into millions, right? So as a result, I think they need to be very yes. they take risks, but they need to. So they are qualified enough. They are, if we put, I think bank level, we put to these positions, then they are reasonably experienced. So, but majority are managing that. Maybe few uh, fall apart. So, so then what the other maybe treasury level? What is the other according to structure, the middle office? What the people in the middle office do? So basically, so we say that front office people get exposed to risks level exposures. No? So people who are in the middle office, they are the controllers, right? So they are closely monitoring, right? What exactly the contracts these front office people are enter into, their prices, whether uh, there is documents, right? They need to, take on behalf of the bank, whether they have done it, whether they have authorized, they operate within the authorized authority levels, whether they have violated the DA, they have been given a DA, right? So these things are checked by the middle office people, right? More or less, they play the role of an auditor, right? So that's the role of the middle office. They are controllers. There are few staff who are looking into the functions of the uh, basically of the front office, because they are the ones who enter into transactions. They are also looking at uh, back office functions, also how the transactions are recorded. So then the back office people, these are the people who are in the back office. So they are the, once the front office enter into a transaction, so they have to take it on from there. So they need to process the payment, and if there is a settlement, so they need to take it over and need to, as instructed by as per the instructions, as per the documentation done, they need to make the settlement. So here the staff are operational staff, more or less. As a result, they don't get involved in frontline level for front level duties, but they need to maintain records, keep records, and transactions in the very orderly manner, right? They can't miss any of these records. So they are, as a result, they exposed to operational risk. But front office people, they exposed to market risk, because they are, quoting prices, and they agree on the prices, and they offer prices, right? So buying and selling is done by the front office. They exposed to market risk, but back office people, they are more or less, they probably can expose to operational risk. Maybe they can miss important transactions, right? So they are in that way exposed to operational risk. And these people are, like I said, monitored by middle office, right? Right. I've been learning for about half an hour, little over half an hour. Any questions? So like I promised, let's straight away go to a video where I think we'll get to know what exactly how this people in the Treasury Department is going to operate, right? So then they will know. So what I've been talking to you in a different manner. So we'll now go and see what exactly what the role of a dealer, and what exactly they are on day-to-day basis do.
Well, what would you want to do? Look at the buy or sell?
I think I prefer to sell. Yeah, but 43 sounds really tight. So why would you want to reduce your position at such a low level? The thing is, if they're changing their dollars into Saudi, that means they're buying and selling Saudi with the central bank. My name's Philip Beckle. I'm co-head of the EMEA FX and Interest Rate Trading Group at BNP Paribas, and we're a group of about 25 traders spread across the Europe, Middle East and African time zones. We also have trading hubs in Moscow, Bahrain, Budapest, Warsaw and Sofia, but London is our main centre where we have the highest headcount. Bleeping sound that we keep hearing on our desk is the Reuters dealing machine, and they're actually incoming calls. And those calls can come from anywhere, from another bank to a counterparty, or even an internal call from another BNP Paribas entity, for example, New York, Montreal, Milan. Everyone has this system, and that's one of the principal methods we use for trading. BNP Paribas. Yeah. There's a bond auction in Tel Aviv for government bonds denominated in Israeli shekel, and we're bidding a total of 700 million shekels. And the order's just going in through now. $100 million is 375 million shekels, so it's just about $200 million that we're doing. We like these bonds because there's a positive, what's called a positive asset swap, whereby the yield on the bond is higher than an equivalent yield in the money market. There was an auction in Hungary today for Hungarian government debt. A news report came out from Bloomberg, which is a news service, and our trader in Budapest was quoted on the report that Bloomberg would have telephoned him up and asked his view on the market goings on, and then he's just been quoted in that report here.
The 67.5, 69.
Situation in Israel is a bit escalating a bit.
Yeah, there's an exchange of fire between Israel and Lebanon. News report came out about 15 minutes ago, and that's typical of the sort of global events that affect our markets, particularly since we're sort of hands-on trading. Conflict in Israel is a fact of life. What we will be watching is if it escalates and gets worse. If it does escalate, then we have a problem. Absolutely every day that we have to eat on the desk. It's only on an ad hoc basis, depending on how much work we have.
Yeah.
$30 million.
What's that?
$30 million cross currency. ING token wants to pay.
As a cross currency?
Yeah, that's correct.
We just got a request for a price in a Turkish lira cross currency swap. It came through our Turkish sales desk through the swap box here. It was an 18-month cross currency swap in $30 million. And we just priced that up, talking to our voice brokers, and then using our pricing system here. If Turkish yields move by 1 basis point, our profit and loss can either go up or down by, say, 10,000 euros. So we just got the auction results from Israel. Put in competitive bids for up to 600 million shekel, and the result was we only got 400 out of that 600 million. It's a relatively small trade for us because that amounts to just over $100 million. Because the duration is so short, the actual economic significance of it is quite muted. I mean, the inversion of the curve still doesn't make any sense to me. But it just is wrong. Thanks so much. If we were trading any other currency like euros and dollars, it's a 24-hour market. But because our currencies are less liquid, more exotic, it really ends with London. And tomorrow's another day.
Right. Hope you got an understanding about what exactly the people in the treasury, particularly those who are in the front office, do on day-to-day basis. So they are the ones who, on behalf of the bank, maybe at bank level, they know what volume of rupees they need for their day-to-day transaction. Whether it could be uh, to give it outside as credit, that is our main business, and also to finance our trading, international trade. Maybe we need to pay off letter of credits that we have issued, so that we need dollars, or maybe some other foreign currency. So like people who have seen in the video, our treasury department people also get involved and talk to other banks, other financial institutions, like maybe dealers like this, fund managers like this, and get their the quantum of funds that they need, right? So they need to be very specific about timing, but because like they also very shown certain cautious about what is happening that in that Middle East area, whether this war is going to erupt at any moment, because according to that, so these their prices can go up or down. So we need to take decisions accordingly. Similarly, in Sri Lanka also, our people have to take the kind of impact is not so volatile for in rupee local currency scenario, but definitely in the foreign currency scenario, they need to be very much need to be very much in pace with what is happening in elsewhere in the world around. Right. So now we are moving into talk about little bit detail. Uh, so what this we know what exactly they are doing. So what they are basically what areas, what are the basic things. What is their speciality. So these are the things that we are going to talk about from now on, right? Uh, so when it to comes to treasury department, so they are actually deal with investments. So right. uh, so what do you mean by investment? So need to clarify that. What is the investment? What does it mean? So investment basically, today we are actually stop consuming and sacrificing that consuming consumption uh, for us to earn something later on, right? So for an example, we have maybe 100,000 you get maybe from another uh, your parents. You either can spend it, you go with a friends a trip, or maybe foreign trip. If not, if it is 100,000 is too much for a local trip, you can go abroad and consume it, right? Or else you can invest uh, in a laptop or something like that, and you start uh, doing some you can do some on your own studies, and maybe get registered to a foreign university and do online course, something like that, and can that's a kind of an investment. You are sacrificing. You're not going to go on that trip. You're not going to consume that entire money. You invest in your future. Or maybe you can like I advise, you can invest in the bank also. You can put it in the fixed deposit and earn interest. Okay? You're not going to earn that interest immediately. Maybe after 3 months, 6 months, whatever the time period that you decide, right? So investment is sacrificing your consumption, what you have to do right now, and if you postpone it to without consuming it, you put it off and sacrifice that to earn something in return, right? There are basically there are various types of investment. So in day-to-day basis, we find real investment, purchase real estate, right? You have see When you go around the country, you have real estate, property developers, they buy and sell property. So there are vehicle people who are in the vehicle and the machinery. So they buy and acquire machinery and sell it to other parties. But so how it is differentiated from the financial investment? The financial investment is basically, property. You have something to touch physically, right? Real estate, yes, yes, you get a documents also. In addition to that, you have a area which you can physically touch, right? Machinery, vehicle is again common, right? But financial investment, you don't see anything that is not tangible, right? That is only in the paper contract. So financial investments, so it is common to loan agreement also, mortgage also, right? So it's a kind of a, again, FT. It's a investment. We deal with the documentation, right? That's the difference between the financial investment and the real investment. So first thing that you need to know here, when we go on, before we are going into details, what is an investment? Okay. Then next, what you need to know, what are the types of investment? One is real estate, real investment, where you can physically touch, and other financial investment which you can't touch, right? So so there are, although we say that there are two different things, but there can be some interrelationships, right? Uh, so for an example, now we have to sometimes there are share issues done by the companies, right? Uh, and so with that money, they are going to purchase some machinery for the company. For example, so let's say company, take an example, let's say a company like big company like say John Keels, they have their shipping companies, right? So John Keels can issue share, and then they can take money from the public and their shareholders, and that money can be invested to, so let's say they are going to uh, expand their terminals in the port, in our Colombo port. So then whatever the money that raised through their shareholders can be invested in developing the airport, right? So there is financial transaction done through share issue investment related decision. It led to a real investment, right? Purchasing and development of a physical asset, right? So that can happen. So there is always interrelationship, right? So again, so our housing loans, right? Uh, Banks give us a loan. Loan is a financial transaction, right? Uh, but using the loan, people or the customers purchase land and maybe houses, right? So that's again, so in real investment and the financial investment, always there is some interrelationship that they will not, you know, they, they have not be in isolation. There is always, there is some interrelationship between the financial and the again the real investment. So that's how these things keep rolling, right? So, so this is the way that real investments get money, and also this is for decision making also. So maybe if the financial the costs, right? Let's say it is difficult to raise money through a housing loan. So when the interest rates are going up, so if if our people, customers can't service their loans with their salaries, interest rates are going up, then people won't take housing loans, right? So for the housing loan customers to take their decisions are actually depending on the financial, the how the financial industry moves, interest rates moves. So all these are things are interrelated, right? Now, then let's see what are the types of what are the activities actually taking place when there is a financial investment takes place, right? So there are markets. We need to we see markets. So then these financial investments take place. So where assets are uh, taking place, buying and selling taking place, various forms of trade and sales, right? So then again, that is linked to securities, right? So when it comes to securities, there are in these markets, depending on the market, there are different securities, right? In a stock exchange, uh, equity, right? Shares are taking place, buying and selling taking place, right? If it is in the money market, it could be debenture, it could be fixed income securities like uh, treasury bills, treasury bonds, right? Uh, so then, so under each of these investments, so to depending on the organization, depending on the financial decision requirement, so they need to senior level people need to take. So depending on the pricing, how much they are going to take these financial facilities, for how long. So these are decisions that they need to take, right? So these are again uh, these decisions are actually uh, taken based on the risk and reward relationship, right? So if it is risky or costly, then the decisions getting delayed, right? If very conducive environment, very healthy interest rates are, prevailing interest rates are prevailing, interest rates are healthy and beneficial for financial investments, so investments takes place. For an example, uh, so some time ago, I think housing loan interest rates, I think through budgets also reduced to about 7%. Also, so then people started taking housing loan, right? Uh, and again, there was some due to certain government policy decisions, uh, people government has taken a decision to ban some of these imports and especially vehicle imports. So the vehicle people who lot of money, people who have a lot of money, the vehicle sale owners and all, their business not started not moving, didn't move. So what they had money, what they have done was uh, they rather than putting that money in the uh, banks, they have went and invested in the stock market. As a result, stock market also started booming, right? So these are some of these things happen. Okay, in certain situations, demands, certain financial sector subsectors to get activated. Certain times banks get activated, financial sector at certain then the when banks are doing well, so people start depositing money in the banks, and so they don't take risks, taking risk and investing in the share market, right? So vice versa, if banks are not doing well, they go and invest in the stock markets and real estate. So many things that they do. So now we are trying to So we talked about different financial markets. Now we are actually trying to move into financial markets, which we find very often in the banking sector. Financial market is also very broad area: stock market, derivatives, and commodity markets, and various other investment banking. But when it comes to the commercial banks, right? So it's a very limited area again, because they need to get a function, need to operate in this space. So as a result, they definitely present, but in a limited area. So we are now little bit, we broadly discuss what exactly they are doing, and so now trying to narrow it down and learn specifically what this Treasury Department people get involved. Right? So basically, when moment we say there is it's a market, there are two types of people: buyers and sellers, right? So even in the midweek or Sunday fair, we call it polar. There are buyers and sellers. That's again a market, right? So there are again many security markets. Okay, the security markets, again stock exchange. So the stock exchange could be New York, Colombo Stock Exchange, New York Stock Exchange. So all these are, so markets, financial market. So stock exchange also. So you Colombo Stock Exchange, you see in the television also, they run various promotional programs in the TV. So people go and stay there, and there are buyers are there, sellers are there. You see the buying price in the screen, big screen, and buying price, selling price, what is the amount, transactions happen, and lot of details. Again, that's these markets are physically available in one area, one place, right? So, but there again in the financial sector, another financial section, another section in the financial sector. So, like stock markets, they are not physically exist, right? They actually work with computer networks, right? People don't, buyers and sellers don't see each other, right? They work with the screens, right? They say so what they are pricing, and if these people are interconnected through these networks, so these platforms give them the confidence, the security, and kind of things. So through their networks, although they are not present in the physical location, transactions take place. The classic example is foreign exchange buying and selling is happening through this kind of computer networks, right? So this is actually this differences whether a market, financial market is financial market exists in a physical location or not. Based on that, we actually differentiate these two markets into two different, identify them differently. So one is organized markets, and the other one is over-the-counter markets, right? So organized markets are the type of market where we physically have place where buyers and sellers meet, and also the prices are given, buying and selling prices are given, transactions take place transparently manner. Okay, classic examples are the stock exchanges, even the weekly fair. To this, according to this definition, you can take weekly fair also as a organized market. Just the opposite, over-the-counter market, they don't have physical locations, right? They don't exist in a physical location. They are connected with computer networks, right? So basically, they are connected through, like we have shown in the video. So they are connected through these computers, phones, and things like that. So they don't meet each other, right? So I think in that video, that person also told they don't meet each other. They don't know. So some people are very much unknown to them. So, but if they see that transaction is beneficial, so other security, so the real transaction or not, so that is taken care of by the platform or the computer network. So they can always go and trace who and what they have agreed upon, right? So everything is recorded, right? So that security is there. So although they don't physical does not happen in a physical location, but the secured manner they perform transactions, but transparency is not there. Okay? So that is buyers and sellers. So individual level they know what the price that they bought, uh, what security and all quantities. So it is not known to other people, right? But if you go to a stock exchange, we all know how much uh, big shareholders have bought and sold, right? So these details are not available in the over-the-counter market. Right. So let's see whether you have any questions so far. If you have any questions, you can put in the chat box. I'll time to time go and see. If I can answer the question straight away, I'll do. So if you need more information, I'll somehow get you the answer. Right. Right. Let's move on. So then again, now we are actually restricted to one area, the financial market. So the financial markets also, there are two types of uh, again subsections, right? One is primary market and the other one is a secondary market, right? The primary market is the play where the new funds issues securities are traded. The fresh funds are actually handled by the primary market, right? The secondary market is comes next, right? For an example, uh, primary dealers. There are secondary dealers and primary dealers. So most talked about primary dealer. I think the bond scam heard of a primary dealer, no? So perpetual traders, treasury, I think, is a primary dealer. So the primary dealers are the ones who, when the government need money for certain projects, their expenditure, they say we need 100 billion of rupees, right? So then they have to work with their counterparties, primary dealers, and they need to somehow get that money, right? Uh, so that's the role of a primary dealer. So for that the central bank issue bonds and treasury bills. So they primary dealers are the ones who purchase those things and give that money, right? And so so currently, so I promise you give some current backgrounds also. Uh, what do you mean by money printing? So what is happening when we print money? What is this phenomenon, right? So can someone tell or anything about it if you know? What is the relationship between this primary market and the money printing? You say we've seen a lot of money printing So a lot of news items, opposition, taking interviews and say that billions of trillions of money been printed during last couple of years. What is happening there? These are some of the things that if you understand properly, you can talk about with anyone. Right? So what happens there is, so like I said, if government need money for their projects or expenditure, so they issue bonds, right? So usually it is bought by primary dealers, right? But if there is no primary dealer, bonds are not sold 100%. So actually, let's say government needs 100 billion rupees. Only primary dealers bought the bonds up to 25 billion. So then government don't have money, no? 75 billion, sure. So what then central bank does is, central bank, they buy those bonds on behalf of the government, the primary dealers. So they have the bonds and the treasury bills. So, and to the equivalent amount, they print money. So this is what happening. If they try to, when they try to raise money through primary dealers through bonds, if they don't have enough primary dealers come and invest in it, still there is, if there is a short, central bank purchase those bonds and equivalent amounts is printed and circulated in the money market, in the domestic in the money market. So that's happened. So there is corresponding entry, there is bond, corresponding bond, but equivalent amount is printed, right? So that's how the money circulation is going on. So if not, so let's say 100%, 100 billion is raised by the primary dealers, then what happens? Always say the secondary market is there, where another broker, set of brokers, buying from primary dealers and sell it to the other parties like you and me and the companies, right? The secondary market, there are again brokers. So they buy those bonds from large quantities. There are so many brokers like that. So they take bulk amounts and they do trading. There is again price differential buying and selling. That markup is the profit for the secondary broker, right? So because the financial industry to perform, operate properly, right? I think this from primary and secondary market is very important. For an example, let's say now in the vehicle market, what is the, when you buy a vehicle, uh, what is the important thing that in addition to the vehicle comforts, another aspect that most of the buyers are looking at, what is it? One important, very very important aspect. Can you put it in the chat box just to break the monotony? Market value. Yes. Yes. Market value, to precise, second-hand market value, right? So second-hand market value, secondary market, right? So whether there is a secondary market for that product, vehicle. So whether if I need money, whether I can sell it and make money, get money back. So that's the understanding, because we are investing in a vehicle. So if they want to get rid of it, whether we can get that money, so whether I can improve my liquidity. So that's the same thing in the financial market also. Financial people who are involved in that, they also think about it. So as a result, this stock market also is also secondary market, right? Because share share issues is done by investment banker. The secondary market is the stock market, right? You know, IPO, initial public offering, is done by an investment bank. So once the shares are issued, so then the secondary market is the stock market, where you and me can buy and sell, right? So with the investment bank allocate, depending on our share application, they allocate, and once we got our shares, so we can buy and sell in the share market. Again, the stock markets are again part of the secondary market. I think hope things are clear to you. But this is kind of a very much, although it is not very high level, so something that you probably wish to learn and know about it, where you can talk and discuss with maybe high level people, not people who are uh, doing ordinary jobs, maybe work in the financial sector. So maybe uncles who do business, right? Maybe if you work maybe in the business, like deposit mobilization or credit side, you handle sales, uh, you meet customers, you need to talk to them and relate to them. So if they sometimes these business people ask questions. So what happened here? What happened to these bonds, and what is the situation in the stock market? So you should be able to what is this dollar issue and things like that. So what is this mini money printing? What is the you know unfavorable things happens when money printing is done? What is money printing? So you should be able to answer that. So that's the kind of, in addition to getting this, I don't think getting through this exam is not very difficult. So in fact, we discuss this at length discussion. In addition to this discussion, we'll probably end of this my 3 lessons, end of the so last 1 hour or so, third week, we take few questions from the covering entire area. So we'll share with you and try to discuss with you. So the questions will be from one of them. So 20-30 questions, and so we'll not the same question, but so we are asking questions from the same area. So I'm generally asked to put one question from my area. That's again a 20 marks question. Okay, if you understand well, learn my area well, should be able to answer without any issue, right? Good. So let's go back to the lesson. So again, we are still in the characteristics of markets. I think we have already discussed about it. So in the primary market, what happens is they are that is the place where we raise capital, right? It could be so primary dealer raise capital, right? Secondary market is the where it additional capital give a secondary market for this, the capital that we have raised, right? So as a result, it gives liquidity to the those who issued security, or security actually capital owners give kind of a liquidity, and also that gives the value for these assets also. So liquidity and value actually generally comes from the secondary market. So as a result, I think like the primary market, the raising of capital, so equally primary market as well as the secondary market also equally important. Otherwise, so none of them will not exist, will survive in isolation. Both need to be there hand in hand to have a very smooth and very strong financial system, right? So that is something that you need to remember. So as you can see, I actually do this lecture from my home with my home comforts. So I, in fact, happened to be COVID positive last week. I think this is the 4th and 5th day. So hopefully another couple of days I'm okay. So it takes little here and there, small breaks. So to just to breathe. I think you are okay with that. Okay, move on. So then, so we then now we have our, like I said earlier on, our area of learning is the portfolio management, right? So we got to know what is financial markets and details of financial types of markets and the characteristics of financial markets, types of secondary or primary markets. Then what is the portfolio? If it is a bank portfolio, you take bank, we have asset portfolio. Asset portfolio has loans, could be term loans, could be business loans, could be credit cards, could be housing loans. There's so many international trade loans, right? So many loans. That is the asset portfolio. Then we have liability portfolio, right? Liability portfolio, we have deposits, fixed deposits, right? So then we have again CASA, current account, savings accounts. So there some banks have annuities, right? So many other assets, and again they have investments in treasury bonds, treasury bills, shares, right? So these are the portfolio. So if it is now the bank level portfolio, so if you can read with me, refers to a collection of investment tools such as stocks, shares, mutual funds, bonds, cash, and so on, depending on investors' income and budget. And again, so organizations' requirement, bank level requirements, so business model, they have their own types of assets. So these are collection of these assets are the portfolio, collection of assets. So it could be the bank level portfolio. So let's assume for a moment banks deal with have their own investment banking unit also, or also they deal with the high net worth customers. They give investment banking kind of services, wealth management. So in that scenarios, banks also have own fund managers where banks officials, fund managers manage high net worth customers funds. So maybe they invest in unit funds, unit trusts, share markets, other liquid assets like bonds and treasury bills. So they have the they have expertise. They, so as much as possible they have to at some risk, yes, but somehow mitigate that risks, and they need to provide the maximum benefit to their customers. That's their role. If they are kind of people who get involved in providing high net worth customers these wealth management services, so they need to be very experts in investment kind of stock exchange. They should know about stock exchange, the trends, the money market, and need to help convince their customers and take business from them. So they again they are giving some return to their customers, as well as they also also take part of their profits as commission, right? So it's good business for the bank, also the individuals also. So it's a kind of a win-win situation. So this is a two scenarios. If you talk about bank level portfolio, it's consistent of all total assets, right? So portfolio management, so it could be again two types. Either Treasury department has to manage this portfolio on behalf of the bank. So again, another area, we have a separate business unit providing wealth management services, where we have fund managers. Maybe they work with the Treasury department, maybe under head of Treasury. So, so that's the way they have their expertise from kind of they have access to what exactly happening in the stock market and the money market, because they have their dealers who are experts. They can get ideas, so and they can pass it on to their, so that expertise can be pass it on to in a beneficial manner to their high net worth customers and provide services and earn some other income sources. So that's another area that you need to think about. Right. So what are the basic things that investment manager, otherwise the fund manager of a investment bank who is handling customers, high net worth customers, wealth planning and things like that. So what they really need to know. So another area that we discuss here. So they have to give the best investment plan, right? So they need to be aware of the investment options of the stock market, other various types of financial instruments like treasury bonds, treasury bills. Stock market is the return where we have the highest return in. If you take all these assets, relatively stock market has the highest return, also the highest risk, right? So when they invest uh, outsiders, customers' money, they need to be very expert and make sure that they're not ruining deteriorating the asset value of this, the wealth of these customers. So yes, they need to have a plan. So they need to decide what assets they are going to invest and convince the high net worth customers. They need to give them the plan. So they give the customized solutions to these high net worth customers, and they have to give approximately what is going to be their return after a given period. It could be end of 1 year, 2 year, or something like that. So basically, these people need to give a investment plan. So they need to convince the customers what type of return that they are going to give. So how they are going to minimize the risk. So what is the more important? They probably can do a comparison. Maybe you can do a presentation to them, giving the benefits and the risks and how he or she is going to minimize this risk. So through that, so you can get customers' opinion, what his or her risk appetite. So if his appetite level meets what you are talking about, and so then you can give your service and so then monitor the progress. So I think that's about kind of investment decisions. So kind of portfolio level management decision. So now we are going to little bit detail into certain areas of our main topic. Right. So we basically here trying to talk about, I intend to talk about fixed income securities, right? So what is fixed income securities? So like I said, so main type of fixed income securities are bonds and the treasury bills, right? So those are the main types of fixed income securities. right? So there are two parties to each of these securities market. This is a market, no? So when the securities are operating in a market, so there are market. We said in a market there are buyers and sellers, right? So who are these buyers and sellers? We here in the fixed income security we use two different terms. So they are simply investor, simply, and the issuer, right? So investor is the one loans, who is giving loans, right? To a corporate, right? Loans made by an investor to a corporate, right? So issuer is the party who is going to borrow money, right? So investor is the corporate, investor is the borrower. So just to clarify that, I'll confuse you. Sorry. Simply, loans are made by an investor to a corporate. There are two parties anyway. Issuer and the investor is the two party. Instead of buyers and sellers, here we call them investors and issuers, right? So loans are made by investor to a corporate or the government, right? So investor investing their money in the corporate or the government. So they give their money as a loan to corporates and the government for their projects, right? So investor is the one party. Then the government is a borrower, right? The borrower is also known as the issuer, right? So loans and the borrower. Loans are loans taken by the borrower. Borrowers are example corporates and the governments who take money for their investments, right? So then the issuer is the investor. So then so all these bonds, they, like our fixed deposits, they also earn interest, right? So of each of these bonds, there is interest component, but we don't call it again here. We don't call it interest. We call it, instead of interest, we call it coupon, right? That's the difference. So again, market, there are buyers and sellers. Instead of buyers and sellers, we call them investor and issuer. So then, so in the FDs, customer investing, actually banks borrowing, right? So bank is giving interest, right? Here, bond is issued by the borrower and investor. Bond is issued by the investor and borrowed by the government or the corporate, and instead of for their investment they give a return. We don't call it interest, we call it coupon, right? So these loans are given for a particular period of time. So fixed deposit, we take fixed deposits for a specific tenor, could be 3 months, 6 months, 1 year. So likewise, so bonds and treasury bills also, there is a specific tenor, right? Treasury bills, they are less than 1 year, 3, 6, 12 months, right? Bonds are more than 2 years. Longer term ones are bonds, shorter than 1 year, treasury bills, longer than 1 year, bonds, right? So that's how we differentiate bonds and treasury bills. But terminology is the same. So amount, the loan amount, we call it the principal. Also, we call it face value or the par value. So these are terminology. So basically, two things: investor and the issuer, right? Investor is the money who provide money. right? So their government is the borrower or the corporate. So they take money. The borrower also known as issuer, right? Uh, so then the lender also known as investor. Lender is investor, borrower is issuer. That's how you can remember. And there is no interest paid for the investment. We call it coupon. So term or tenor, we call it maturity period or maturity date. The amount that we borrow or invest, we call it principal, face value or par value. Those are some of the terminologies that you need to remember. So now let's put into numbers and see, try to understand what this is, right? Again, I need to drink a little bit of water. Right. So with these numbers, you should be able to understand this very clearly, right? Right. So let's read with me this question, then we'll sort it out, right? So the annual interest amount is found by multiplying the coupon rate by the securities face value, usually 1,000. So let's say 1,000 is the par value principal. The how do you calculate the coupon amount? So for example, bond with 5% coupon and 10 years maturity, right? Will pay 10 years maturity. So 1,000 into 5%. 1,000 into 5% is $50, right? The $50 is the coupon amount. So $50 per annum, right? 5% per annum, no? The coupon. So then 5% per annum, 1,000 into 5%, $5, right? So $5 will be paid right throughout the 10 years, right? So certain times these $50 are paid annually at the end of the year. Sometimes the 50 can be divided into 4. You can pay $12.5 each quarter, end of each quarter, or semi-annually, maybe end of June and December, $25 each. So that's the ways that we can pay this kind of coupon amount, right? So like you take your interest on monthly basis, for you can fix deposit and you can earn your interest on monthly basis, no? So similarly, there are certain ways that coupons are paid, right? So how you basically, how you take the face value and take that percentage and do a calculation to calculate the coupon amount, right? So that's how it is done. Right. So without further ado, let's again go and look at a video just to break the monotony and give some interesting stuff for you to understand. Because since this is not, we don't see this in our day-to-day life. It's only way that you can get an understanding what exactly happening is through this kind of videos. Okay, here we go.
We're on the trading floor of Vanguard's fixed income desk. Can you describe the process of what our traders go through throughout the day to make moves for our clients?
Sure. So traders are going to be given orders from portfolio managers. They're going to take those orders, and the first thing they're going to do is look at liquidity in those markets to see how they should go about implementing the strategies. They have many different tools at their exposure that they can use to execute, and they need to go about it and find the most appropriate and best way to implement those strategies without having a tremendous amount of impact or having a ton of cost to our shareholders.
So is there a lot of movement? Are they monitoring different funds, and what does that look like?
There's a tremendous amount of movement throughout the day in all the different markets. Typically, we're segregated in different areas of expertise. So you're going to have an FX trading desk handling all the FX orders. You'll have a fixed income desk handling the bond executions, and then you'll have another desk handling all the derivatives executions. And that way, those traders can specialize in the different asset classes, because ultimately they want to be able to execute in a way that limits the amount of impact and limits the amount of cost that it takes to trade.
So how many funds might one trader be monitoring throughout the day?
It depends, and it's different by desk. We like to set up our traders with the portfolio manager. So in that situation, it might be a very custom desk where it's just emerging market bonds. In other functions like FX, those currency traders are handling all of the currency needs for the entire organization. So coming from equities, fixed income, even from our international sites. And that way, those traders are just specializing on that specific asset class.
When many people think about Vanguard, they think about indexing. So can you talk a little bit about our active trading strategy?
Sure. As one of the largest active portfolio managers in the world, a tremendous amount of the trading that is done here is for the active portfolios. Very similar to trading for index portfolios, where the main difference is portfolio managers are trying to outperform the benchmarks. Therefore, traders tend to be more aggressive, and the urgency is much higher when trying to get active orders done. Ultimately, costs still matter, and the lower amount of cost that we can have when trading, the better it is for our shareholders at the end of the day. There's a tremendous amount of collaboration throughout the different desks. A lot of what happens in the fixed income market affects the currency market, affects the equity market. So there has to be a lot of interactions between the traders. And also with our screens, we get a tremendous amount of information delivered to us daily, and we got to decipher what that information means and how it's going to impact the securities that we're trading.
So how does the work that our traders are doing throughout the day impact our investors' goals?
So ultimately, costs matter in returns of portfolios. All the traders here, including the traders around the globe, have our shareholders' best interest at heart. We want to keep the trading costs at a minimum to give our investors the best chance of success.
Right. Hope you got it. And right. So let's go back to our presentation once again. So hope you can see my presentation again. Right. So now we know what the portfolio is, how we are going to manage the portfolio, what is consisted of portfolio, and what is fixed income security, right? What is all about this treasury bonds and treasury bills and things like that. So now we need to learn how we are going to manage these assets categories, right? Little by little. So what we are to manage, right? So for manage, there should be some variabilities, right? So which affects, if something goes wrong, it should negatively impact the customers and the organization, right? So there is again the market, we call it about market risk, right? So these are always tagged to a certain price. The prices going up, like in that video that gentleman is talking about, increasing the shareholder value. They need to pick the right price, right? So they need to make some profits for their shareholders, right? So if they don't manage these variables properly, so they get into trouble, and they are shrinking their profits, and ultimately they don't make the right decision, they lose money also. So as a result, so it is very important for us to know what these risk factors, what areas that we need to make, we need to check on, and what areas, what are the risks that we need to manage, right? So these are the things that basically we are going to touch upon or learn in a moment, right? So one very important aspect or area in the financial market is the interest rate movement, right? If interest rate move in the right direction, favorable manner, that's okay. But if it moves in the different direction, so that definitely deteriorate your financial returns, right? And also, fixed income securities, the coupon rate, definitely that 5% coupon rate, that amount is the one aspect determined by the interest rate of the industry, market interest rate. And the maturity time, if it is a longer tenor, so if it is a bond, if it is a kind of a longer tenor, so 10, 15, 20, 30, up to 30 years, there are bonds. If it's a longer tenor, so there is a kind of a difference in the coupon, right? Then again, the credit quality, right? So if the issuer has a higher credit quality, so then they expect a very high level of kind of return, right? So and also, so uh, uh, if these bonds are invested in a corporate which has a higher rating, triple A or triple A plus, then you are not going to get a good coupon rate, right? Because there is no risk, no. So if the rating is lower, actually the issuer or the investor expecting a higher return. So the credit quality of the borrower is also influencing the coupon rate. So what are the three factors affecting the coupon rate? One is the market interest rate. The other one is the maturity date. If the longer tenor, so then have to give a decent reward. So coupon rate, if the longer tenor. So then the credit quality of the actually borrower. So if the borrower has a higher credit rating, maybe investor can be happy with he may be happy with the lower coupon rate. But if the lender borrower's credit rating is little below par, so then he requires a higher kind of a coupon rate. So basically what you need to understand is there are three things that determines the coupon rates. So now again, like in the financial market, we also in bonds also there are some terminology so that you need to be aware of. Okay, so bond yield is something that you need to learn about, know about. Bond yield is the expected earnings realized over some time, represented by a percentage, right? So, so bond yield is the expected earnings. It could be the coupon, and also you can get capital gains also because you buy at a certain price. So by the time you sell it, you can sell it at a higher rate. So then you get capital gains, right? And so that throughout the period you can earn some earnings. So bond yield is the total of this coupon value and also the capital gain. If you sell it at a higher rate, so you get a profit or the capital gain. It could go either way. You can make losses also if you sell it at a lower rate. So for an example, the sovereign bond that the central bank governor is very confidently said that he is going to settle the bond on 18th of January, which he did. right? So, but I'll show you in a while. The bond prices, so halfway through, I think these are 5-year bonds. This value of these bonds prices have come down to the 40% or 450, 60, 40%, right? So then their earnings have come down. Bond yield, we say it's come down, has come down to 40%. That's the bond yield, right? So return. So the yield to maturity is another terminology. If let's say that the bond is held by a certain holder during the entire period, if it is for 5 years, the entire 5 years, then the total return anticipated on a bond, if its unit is until its maturity, then the yield to maturity. So if the bondholder decides to hold on to the bond without selling it until it matures, what is the earnings that he expect? So that's the yield to maturity, right? Throughout holding period, how much is going to get earning. So these are two areas that we need to think about. Right. So what else? So what is the relationship between coupon, yield, and total return, right? So there are again relationships, right? Coupon, yield, and the total returns. Total return is the capital gain plus the coupon, total, right? So it says price and also the price of a bond and yield as a rule move in the right opposite direction. When the prices of the bond goes up, uh, earnings of a yield of a bond will come down. So that's the rule of the thumb, right? So there is some inverse relationship between bond price and the yield. So that's something that you need to remember. So one important relationship is the bond price and the yield, right? So that is opposite direction. So let's try to dig into a little bit further into that. So let's say now the first point, what is trying to say is, when the interest rates falls, right? So now let's say we have issued a 5-year bond, right? At that time interest rates is, let's say, 5%. So now that so depending on the interest rates on only coupon decides, let's say the coupon is also, let's say, 5.5%, right? So now interest rates suddenly drops, right? But the coupon that issued 5%, 5.5%, you cannot change. The market interest rates can go up and down, right? So what happens? So now let's say 1st January we have issued this bond, 5-year bond, $5 million 5-year bond issued, right? And that is, the coupon is 5.5. At that time 5% is the interest rate. So suddenly interest rates come down to about 3%. So now we are in the February. Say now interest rates has come down. So now if you want to issue a bond, you can't, coupon rates cannot be at 5.5%. It should be somewhere around 3%, because coupons decided by the current coupons issued, decided by the current interest rates. No, that was issued in January. Nothing much can be done. So subsequently interest rates have come down. So what happens? So the bondholders, the investors, again like to buy and bid for that the coupon which has issued on 5.5%. They can bid and buy that bond at a higher rate. So maybe they think that 5.5% coupon rate is beneficial for them. So maybe they pay a little bit of higher price and purchase them, right? So as a result, the higher coupon rates make these bonds attractive to investors willing to buy these bonds at a higher premium. As a result, the bond prices can go up, right? So that's one area that we need to, when the bond prices, interest rates are going down. So like I said, the bond price has gone up. So that's the reason, right? So conversely, that's just the opposite. Let's say now interest rates rise, right? So 5.5% no January 1. So earlier we got 5 and coupon rates were 5.5%. Now suddenly interest rates have gone up to 7%. So now what happens? So now the bonds issued, if we are going to issue a bond, now the coupon rates should be somewhere around 7%, 7.5. So now the 1st January issued 5.5 percent bond will not have any appeal, right? So they are not, nobody goes and buy any bonds, old bond issued on the 1st January. So now the demand is for the new coupons, which has new bonds, which has a higher interest rate coupon. So so that then what happens is there is a tendency, people who own that 5%, 5.5 bonds which is bought on 1st January, they can sell it at a lower rate. So as a result, now the prices are going down of the original bond. So these things can happen. I hope I have explained both the scenarios, when what happens when the interest rates are going up, what's happened when the interest rates are going up. So again, both scenarios are well explained in these two areas. So hopefully you can read and understand also if you don't understand. So let's put this into numbers and try to understand this, right? The first scenario. So there is a 10-year bond. So you can read with me. So then both parties are on the same page. So before that, let me go and see whether you have any questions in the textbooks. Treasury bills and government securities, right? So government securities, government securities are the two, just treasury bills and treasury bonds both belong to government securities, right? So those two are types of government securities owned by the governments, right? So the difference between treasury bills and bonds is the tenor, I think. So treasury government securities is the common name given for both the treasury bills and the treasury bonds. And the difference between treasury bonds and treasury bills is the tenor of the treasury bills are shorter, less than 1 year, and the bonds more than 1 year. To generate is from 2 years to 30 years. So now let's go into detail about this explanation. Example, let's say there is a 10-year bond with price of 5,000 rupees and a coupon amount is 200 rupees. The yield on the bond is calculated as with the formula below, right? So how do you calculate the yield? We know. So early example, 1,005% is, we said 50, no? So now the other way around, we calculate interest on bond, coupon and the market price, and multiply by 100. So yield is 200 is the interest component of the coupon divided by 5,000, the price, and the yield amount is 4%, right? Suppose the price of the bond increased from 5,000 to 5,500. due to the strong investor demand, right? So there was a demand, so that result, that price has gone up to 5,500. So the bond now trade as price at 10% above the issuance price. However, the coupon amount remains the 200 rupees. Then calculate the yield. That is the change in yield, right? Now the coupon you can't change, no? Coupon something fixed, 200, but market price has gone up, right? So market price has gone up to 5,500. So now 200 into 500 divided by 5,500. So into 100, 3.64. So that 4%, when the price was 5,000, 4% yield has come down to 3.64 when the price have gone up. When the price gone up, yield comes down, right? That's the same thing which we have earlier learned, explained in the example. So now just the opposite. Now suppose the price on the same bond considered above decrease. Now let's assume the price of the bond comes down. So now the coupon is just the same, 200 rupees, and bond price falls to 4,300. Let's say now what is the bond price? Yield 200 divided by 4,300 into 100, 4.65. Now the price have come down, right, from 5,000 to 4,300, and the yield has gone up from 4 to 4.65. So that's the relationship. That is inverse relationship between the price and the yield, right? Hope this is very much clear to you, as I explained in this couple of slides. Right. Let's couple of slides and we'll take a break thereafter. Maybe next slide. Yes. Right. This is first stop. So then what are some risks associated with the fixed income securities, right? One of the major risk is interest rate, right? So when the interest rate changes, then it is a risk for because there's yield different changes. So as a result, the risk is one of the interest rate risk is the change in interest rate is one of the major risks for fixed income securities for their investment value to deteriorate. And again, longer tenor, bonds are actually respond more sharply to the changes in the interest rate than the ones with the shorter tenor maturity. Because shorter tenor, they can, take it, absorb, adjust to the this. There is little time to maturity. There is longer tenor. Bonds have longer time to mature, so they respond very quickly because their prices and yields quickly adjust it, because otherwise it is too late. So, but shorter tenor not very actually respond very sharply to the changes in interest rates, but longer tenors ones definitely. Then another area, the credit quality. Again, like I said earlier, rating of the borrower is again also another risk factor, right? So because these are investment, so if you don't give the money to the right borrower, select the right borrower, so there can be a default, right? So as a result, credit quality of the borrower is again another risk factor, right? So one is interest rate, the second one is the default risk by the borrower. So the credit risk of the rating of the borrower is again the risk factor. So two things discuss: interest rate and the credit quality, and the final risk factor is the exchange rate, right? So, two different exchange rates, right? So let's say US dollar, US investor go and invest in euro bonds. So if euro bonds, if the euro depreciates against the US dollar, so then US investor is likely to lose his value of the investment. So there again, what you have to remember is the investment value of fixed income security is exposed to three types of risk. One is the interest rate, the other one is the value of the security, the credit rating or the credit quality of the borrower, and finally the risk of the foreign exchange risk, right? So these are the three types of risk. So managing a portfolio, managing foreign exchange portfolio is managing this risk. How are you going to manage the interest rate risk? How are you going to evaluate your borrower and select the right borrower? How you take the investment decisions, and how are you going to manage the foreign exchange rate risk if you are going to issue bonds or buy bonds of foreign denominated currencies. So with that, we'll take a break. So I think we'll meet around 3:50, and so to continue the session until the end of the class today, right? So we'll come back at 4:50, 3:50. Hope everyone will join. So take a break and take a cup of tea. So I also take some rest and come back fresh, right? Thanks. We'll see you 3:50. Can you see now? Central Bank Circular, press release.
Yes, sir.
Yeah, right. Okay, great. So what I'm trying to show here is, so we little while ago discussed about a bond which our central bank governor promised and actually done the payment on 18th January. So little while ago we discussed about the relationship between the two parameters, the price and the yield. So now you see, let me try to make it little bit bigger so that you can clearly see it. So these are in this left hand side, there is a window where it is listed all the bonds issued by Sri Lankan government, which is to be matured in 2022, 25, 27, 2023, 28, and up to 2030, right? So so on the right hand side, there is a movement. Give me a second. How this the yield curve moves is given in a graphical manner. So in addition to that, onto your right hand side, on top there are some arrows given, and it has come down to about 40%, right? So this is the 40% is the 40% is the percentage year to date maturity. If these bondholders keep this bond until the maturity, the 18th January this year, this is what the yield is going to be, so 40%. So that is the reason why some opposition people, so this from you can see at certain point in May 2021, the yield and prices of this bond is very much low. So if someone has now the prices of this bond, which is taken bought for 100 rupees, for an example, could be in May, could be 25-30 rupees, right? If someone, so opposition's claim was, if someone bought these bonds at 25 rupees, and if that happened to be what they claim is government, people who are around them and bought it, now they are settling it because they want to make them happy, so they get the full payment, right? So once when the government settle that, they are not settling the full 40%, they are settling the entire payment plus the coupons in dollars. So that's the, I think, the opposition's claims. But in this press release, government, central bank has vehemently rejected all these claims, and they're trying to say that so the central bank wanted to buy back. So but some because for them to buy back those bonds, those who currently own those bonds, purchase those bonds, need to they need to agree on that. But it looks like central bank is claiming they tried to buy that back, but bondholders didn't like it, so then that option was not possible. So the two things, one thing is just to give you an idea about the price and the yield relationship. So how the scenario, like in Sri Lanka, can put it into general context and explain it to somebody. So what opposition talked about, and we can try to understand what it is. So I'm not saying that is correct or this is correct, but both, there is a chance for both sides to be the correct, right? So these things happen, these things can happen, right? So this is also shared with you, so that you can read and understand that as well, right? Next, so we'll go back to our presentation again. Right. Can you see my presentation? I changed the presentation. Yes. Hope you can see it, right? So let me see. Yes, right, great. So one more thing, I think this is just to run through these slides. I don't think there is this is just to give you some basic understanding of how to do present value calculation, because this understanding is required maybe next week for us to or maybe next week or the week after next, for us to understand how to calculate the price of a bond, because this is the principle that that we use to calculate the price of a bond. I hope you at some point in your course, during this course, you learn how to do this present value calculation. But just for me to give you an understanding, just to give you some kind of help, I have put these slides so that it is for you to refresh your memory, so that we are well prepared when you when we start doing this bond price calculation. So basically, a present value calculation is done. So when we get some cash flows, so we have a discounting factor. DF is a discounting factor, and we multiply that discounting factor with the cash flow. So again, other way of doing is discounting factor is 1 divided by 1 plus r to the power 1 or T, whatever. So number of years, right? So when you do some few calculations, you know exactly what it is. So present value is, so again the definition, we straight away go to a sum, so that you should be able to know. So the computer, the you just bought a new computer, 3,000 rupees. The payment terms 2 years, same as cash. If you can earn 8% on your money, how much money should set aside to today in order to make the payment when you due 2 years. So 3,000 is the value. So we are going to pay 3,000 in 2 years. So the interest rate is 8%. How much money that we need to keep in the books? So how are you going to calculate? 3,000 divided by 1 plus uh, R. 1 plus R. 1 plus R is 8%. 8% is 0.08. 1 plus 0.08. 1.08 to the power 2. 2 years, not 2. So when you simplify this, answer is 2,572. This is, so what we did was, we got the 3,000 rupees in 2 years. So what it is today? What is the present value of 3,000 in 2 years time? So we calculate the present value of 3,000, which is in 2 years. So you put it into a general formula. How do you do it? Present value is calculated when you have different cash flows. We divide each cash flow from the time that we receive or pay, right? If we receive it positive, pay it negative, right? That's how we do it. So so let's see, this is there again 2. We get 100 rupees in the first year, 200 rupees in the second year. So what is the present value of that, right? So we interest rate is 7%. 1 point plus 7, 2. So we divide each one and added it up. So value is 261.65.88. So how did we how did we do that? So 0 is today's price, today's terms. So 100 1 year, we convert it to 100 divided by 1.07. The present value is 93.46, right? So then again 200 divided by 1.07. There are 2 sevens, I think. 1 7 you need to take it off. 1.07 into the power 2. The value of that is 172.42. So when you add it up both together, 265.88, right? That's how you calculate the present value. Similarly, you again there is an example. Given $2, one received here. One received a year from now, and the other one 2 years from now. The value each commonly called discount factor. Discount factor is 1 divided by 20% is the interest rate. The other one is 7. Discount factor. How do you calculate discounting factor? So this is 0.83 for 20%, 1 year, 7%, 1 year, 2 years. It's 8.87. So we can, we can do this way, or we have a present value table also. So let's see how do we get this 7. You remember 20% and 7%. How do you get this 0.83 and 0.87? Let me show you that. Right. So this is the present value table. So, 20, 21%, 0.82 here. The last for 1% column, last item 0.2, and again 2 years and 7%, 87. You can take this value straight away from this table also, right? So you can do it either way, but only thing is for complicated cash flow calculation, you have to use this table. You can't do it manually, right? So that's the message that I wanted to give it. So this is something that we learned a little while ago. So this is a cash flow. So this is the discount rate is 5%. So I'll give you 5 minutes. Can you all do this? The year 0, there is cash outflow 170,000. Year 1, there is 170,000 again cash outflow. The year 2, 320,000 cash inflow. So can you all do this sum? I'll give you 5 minutes. Can you try it out? You need the present value table also. I'll share that as well. Right. I think hope yeah, give some try. So let's get on with the solution, right? We need to calculate the present value, right? So this is the you have both ways. The discounting factor 0, then the full discounting factor is 1, right? So you have minus cash flow. So 1 into 170,000. Your discounting factor, either you can get it from this or from the table. So if it is fifth or sixth year cash flow, it is very difficult to use the calculator and do it. But then in that case, you need to have this table. And the first year, again, there is cash outflow. So when you multiply again 95,000 something negative, so you are getting about 320,000. And the second year, the discounting factor 290,000, 245. So add up, you get the net present value. The similar concept we apply when we calculate the bond price as well. So just to give you some understanding, only I actually thought of bringing this couple of slides so that you are comfortable when we do that sum, right? So that's come to the end of that session. So now we'll go to another section. So this is we fixed income securities we have done. So now we are moving into equity fund management. So stock, it is something to do with the stock market. We earlier on discussed certain things to do something with to do with the financial market in general and the money market, where we deal with treasury bills and bonds. Here we going to talk about more about equity. So this, if you take the risk perspective, I think risk perspective, the equity market has the high level of risk when compared to money market. Money market, there is risk, but not to the extent that we expose in the equity market. So let's see how what I'm going to learn in this session. So how in general, historically, what happened. So particularly in Western countries like USA. So how are you going to measure the portfolio risk of equity portfolio, calculating the portfolio risk. There's a method to calculate portfolio risk, and so that we need to use some techniques. And so another way of mitigating the risk is mitigate the risk, diversifying the risk. So these are the areas that so investment portfolio we are looking at, right? This is I think in US. This shows the movement of $1 investment in red shows common stock. That's the share market price. Then the US government bonds and the US Treasury bills. Okay, so these are the three items. All three equivalent $1 in 1900. So how it moved? So you can see red moves very on top of the other two graphs, very up and very steadily going up and up, up and up and up. There is very big bridge gap between these two. So it shows if you want to get a good investment return on investment, the right choice is equity, right? The treasury bill and treasury bonds, it gives a market capital gain of 6,147 vis-a-vis about 15,000 times in stock market. So you should know which has the highest return. But similarly, the risk also the same way. So you can in the stock market you can go either way. So sometimes you lose also, but treasury bill and treasury bonds, you are at least guaranteed the coupon. So which is guaranteed by the government and uh, the par value principal, you will be getting it back. But in stock market, you can lose the entire thing also, right? Complete bankruptcy also possible, right? So that is something that you need to keep in mind. So same thing. Let's see how it happened in India. So we don't have data in India for about 100 years or more. In India, it started in even after in Sri Lanka, stock market developed after Sri Lanka, but they have some data since 1978. So there again, during this short period also, uh, government securities and bonds 1,100 times and 2,700, whereas the stock market it jumped about 13,000 times. So this Asian scenario and the US scenario both says, so if you are looking at returns, the best option is stocks. But there is, if you take the risk also, there is risk also there is very high. But in government securities, it is their return is low, but you are sure of getting your at least your money back, right? So that's the two different things. This is again a local scenario, somewhere in early in 2010-11 period. So one of our very unique share in the share market, the demo share price movement. So it was in 2009, I think latter part of maybe from 2005 onwards, vehicle market prices are very low during that price, right? So vehicle not a big business, right? So as a result, companies like Demo also didn't do well. But as we go along, so by the time 2010, mid of 2010, war is over. Government has come out with some free economic policy, and they actually uh, reduce duty on vehicle. So as a result, vehicle prices have come down drastically. Even the Benz and Demo has a whole range of Isuzu and a lot of Isuzu, not Isuzu, Tata range, Benz, and a lot of very, very high value vehicles. So before this reduction, the Benz was very luxurious vehicle, but after tax reduction, so a lot of people wanted to drive Benz, could drive. So as a result, they sold quite a lot of units, Benz and high-end vehicles. So as a result, their company earnings went up, their share price has gone up. So from but 100 is little less than 100 rupees, it went up to 1,800 in March 2011. Say it's about within about 1 year or so that has jumped very rapidly. So that's the nature. So very low level, but you need to pick the right share and right direction. So if you make a mistake, you are losing. It's just to give you an idea, right? So likewise, we can calculate the rate of return from 1,000. In US they have done this. They have this data, rate of return of these stocks, right? Each stock, and they have tabulated, put in a graph. So there are certain years very good return. So there are certain years in 1,900, maybe 5 or 4, there was a big loss. Again 7, big loss. There are again up and downs, right? So if you get caught to a share when this is going down, a negative zone, you are losing money. So if you're lucky enough, if you get in the positive zone, then you are, but majority positive, but it goes up and down. So this is the risk, but in overall, it is going up and up, right? So that's the scenario. If you the same thing in India. So, but in our Indian stock market, it's not not doing a lot of drama like unlike in US. In a couple of years from 1978 to about 5 years, right, in negative zone, but very often we see that in the positive zone, right? But you don't see the positives also not very big, you know, lines, right? Very positive, very marginal, mediocre kind of return. That's the reason why they're not in maybe in the negative zone also. So you can just to give you an idea, you can put it in statistics. You know these histograms, the bell-shaped curve. So you can put it into kind of a histogram. Then each year, how many returns gave you between negative 50 to 41? No, similarly, positive about couple of cases, but majority, you know, placed in the center. It's a kind of a bell-shaped movement you have learned in this statistics. You get from the middle to both sides. You have this standard deviation, right? Uh, Standard deviation is the variance between the highest and the lowest return, right? So this is always market returns move in a bell-shaped curve. So if you take the standard deviation versus expected return, uh, so that then you can again put it in a graph. So again, that also you call this investment B. So this investment, this is a kind of very evenly spread, right? Very standard bell-shaped curve. In mid, you have fairly good return, about 20%, right? Return, and there are a couple of cases you earn very little, 2%, and again 2% about 2% again return of about negative zone 1, 2, 3, 4 negative zone, and again positive zone also. So this is a kind of a very average portfolio. The certain portfolios, they have a very good return, right? Positive return. It is keep to a right. So it is more towards 50% market return, right? The earlier one, so it is not touching 50%. It is ends up with 25% rate, right? So again, that moves to 25% negative return also. So it's 50-50, right? So here, this portfolio, this stocks give a very high chance of you are getting higher return, right? So it is skewed to positive returns. So again, this investment also has a relatively good return, positive return, right? So likewise, you can put it in a graphical manner and understand what happened to these shares, what the return, then how it moves, right? So that's how we learn the trends of share market prices for us to understand the movements of the share market prices. So then we talk about particularly in the equity market, there are two concepts. One is diversification, and the other one is unique risk, right? So there are the company to company, industry to industry, there are some particular risks. There is in the hotel industry, there is a particular risk. You know, if you don't get tourists, it is going to do badly. So this is what happened to tourism industry right now, hotels, right? They're not doing well. Now, because of COVID, pharmaceutical and hospital industry, doing extremely well. Retail industry is doing extremely well, right? So the construction may be doing well. So because it's governmental loan. So there are certain industries, there is typical kind of a risk element. So you're not going to, at this point, no one going to invest in hotels, but pharmaceutical and then kind of hospitals, yes, right? There is good return. So if you put, we watched a video of Warren Buffett also, who is a very well-known investor, very one of the richest person in the world. Some time back, now it's overtaken by Bezos of this Bezos, and then now Elon Musk is the richest person, right? So the earlier days, Warren Buffett, he was very expert in investment decisions. We'll listen. I'll show one of his videos also, how he has taken some decisions. So, what one good thing he has told is not to put all your eggs in one basket, right? It's managing risk. You spread your risk across different investments with different risk levels, right? You don't put all the eggs in one basket. You don't. Then if get one rotten, entire thing get rotten. So you lose everything. So share market also, what his advice is not to put all money in one share. So you need to invest in hospitals, invest in, if you're not sure of right now, in hotels, you don't put, even right now you can invest small amount. When it picking up, you are going to get a very good return, right? So hospitals, banks, right? So you have a lot of other investments. So diversification is by you are putting your shares in different asset categories, different companies, industries. But by doing that, have the possibility of diversifying the risk, right? You are not exposing by unique the risk that is unique to that particular industry getting diversified, getting mitigated by investing in different uh, industries. So you're not losing entire thing. Yes, you get hit in certain areas, but while hotels doing badly, your hospitals can do extremely well. That's this get even out. So as a result, overall, you are not going to get affected. So this is when it comes to risk mitigation. So diversification is a very good strategy. But there is in investment, there is a risk that by diversifying to any level, you can't diversify that risk, right? There is a element of risk in the market which you can't diversify. Okay, that is called unique risk, or also we call diversifiable risk. It is affecting only that firm, also called, because it is unique to that company, like hotels. Tourism is unique to that industry. That we call it diversifiable risk. But that risk you can't diversify by investing in different. But that level you are exposed to that, right? You are anyway get that. You are bound to get that hit. You can't limit that. You going to get that hit, right? But only thing, you have total investment. You are putting in different things. You can diversifying investment different areas. You are not expected to lose entire thing. But if you put everything in one thing, because since it is unique to that industry, if it is not diversifiable, since it is not diversifiable, it goes bust. You are losing the entire thing. Okay, unique risk is something that you can't unique to that company. So the market risk is something that that is in a market you have it. Okay, so that of course that is we call systematic risk, right? It is non-diversifiable risk, right? You have it. You are going to get that risk market. So any market, so nobody wants to come to Sri Lanka because we have a market risk. Okay, we have a dollar crisis, debt crisis, the import restrictions. Our market is gone bust, right? That whether you anyone wants to invest in hospital or our construction, banks, or hotels, or anything, retail. So macro level thing you can't get rid of it, any investor. So you get that hit, right? So but industry level things you can diversify by different investing in different investments. So you need to understand what is diversification, what is unique risk, which is unique to that particular company, uh, which is unique to that company, which cannot it is diversifiable, but by diversifying you can get rid of that. But market risk, which is not diversifiable, so it is common across the board. So these are three concepts that you need to understand, right? So again, another concept that I want to take it up here when we discuss about measuring risk. Portfolio risk, a number of securities, right? So I said when you have a portfolio of a lot of, you invest in different companies, different companies. Zero is you are not investing. You are investing in one company. Your portfolio is very high, right? Risk is very high. If you hit the right share, you get a high return also, right? But when you start investing in different uh, companies shares, your portfolio risk coming down, right? So at the same time your return also coming down. So after a while, now this graph getting flattened, right? So after a while, so that flatten means that risk, yes, risk has coming down by diversifying, but there is at some point, after some point, that risk you cannot uh, get rid of that risk. That is the risk, we call it market risk, which cannot be diversifiable. So you are exposed to that risk, right? So you have to live with that risk. So depending on the country macro situation, that level, where this flatten, where does this flatten, top or down, it determines where the market, the sentiments of that country, ease of doing business, and the macro level, so the market situation. So all depends on that's why foreign direct investments sometimes we don't get attracted. It is get attracted in China, Malaysia, Indonesia, the countries like that. Even Maldives got foreign investments for tourism. We don't, because our macro level things are not very solid, right? So it's something that we cannot get rid of. It's a policy level, government level decision, right? So this is again we call it in particular investment. So there is unique risk and also market risk. So the market risk, again, you can't get rid of that. That is common. So now try to do a small calculation. Suppose that you invest 40% of your portfolio in Reliance Energy and 53% in Grasim Industries. The expected return on your Reliance Energy stock is 17%. Grasim is 14%. What is the expected return on your portfolio? So this is equity market. When we study in equity market, we learn certain concept. We learn to do some few maths, so few sums, stemming from some of the concepts for you to understand these tools. So don't take very seriously, just small calculation. I think so. Once you go through it, you should understand. So you don't have to worry about it. You should understand. I guarantee that. So now we have the portfolio level, how much we are invested in two different investment, and how much we expect from each of the investment. So we have invested 40%, and we are expecting a return of 17% there. And other investment we have invested, so 100% is the 47 plus 53%. Our total investment 100. So let's say we have 1 million. I have invested 470,000 in one, and 530,000 in another. So that's something that you can assume. So 47% into expected 17% return, and other 53% expecting 14%. So overall, I am expecting. So when we add it up, this is the overall expected return. So this is something. So if you have a portfolio, this is how you calculate the return on the overall portfolio. If you have multiple a portfolio, multiple assets or shares, so this is how we calculate the average expected return of the total investment. Right? This is something that you need to remember. So so again a concept that we very often. So any stock markets, in US or any other stock market, the beta factor we call it sensitivity of a stock. So return to the return is market folio is we call it beta factor. Beta factor is if you have a portfolio of assets and how sensitive their prices going up and down, the return. So by going up and down, the return also getting volatile. How sensitive is that? The stock market is a industry, that's a universal thing, big ball. But in that there are so many investments. So there are each investments returns can go up and down. But like I said, there is overall expected return. By average it out, you have an overall return also. But there are certain volatile shares which has a higher beta. When the sensitivity is high, we say the beta factor is very high, right? When the sensitivity is low, we call it beta factor is low. Okay, so basically it could go. One is neutral. Okay, if it goes to point something, sensitivity is relatively low, but 1 point something, there is very highly sensitive, right? So if you take efficient frontier is another concept. So if you take all the portfolio, so stocks, you can you take graphically. If you can put all these stocks risk return combination. So there can be 50% risk, but you get a 50% return also. You have the high risk, high return, right? So you have 50% risk, but you have 5% return, right? You have a 5% return. So that's a high risk, low return, right hand side down. So now left hand side down, you have low risk, low return, right? Your treasury bills and things like that. Low risk, low return. There is no risk of default. You government backed securities, but you have got a low return also. Then on top you have low risk, high return, right? There are some assets that is low risk, but you are going to get a very good return. There can be shares of that nature also. For that, for you to understand, you need to know in and out of company, how they operate, financials, markets, overall macro situation, how the global economy works, and everything. So then you should understand. So basically, you need to understand this efficient frontier for you to have a good kind of a game plan in stock market. Otherwise, you are going to be a loser, right? You need to be up on the everything, up on the scene. So you need to be very everything should be in the fingertips when it comes to industry, financial, and things like that. So this is the efficient frontier, another concept that we learn. So basically, based on the return and risk of each of these shares, we can plot it, and this we try to invest in this graph. You see a graph now. So the most efficient shares are lying in this graph. This curvy one. So if you can pick and choose those shares, they're going to be going to give a best outcome, right? This is something that you need to learn, right? So with that, again, we try to derive a formula. So the market return, so risk-free return, we have different. So efficient portfolio is the market touches the our efficient frontier, right? So we have a formula. So return, we have this assets. RF is risk-free return. That's the rate of treasury bill or treasury bond. So it is known to everyone. So it's publicly available. So other share market prices going up from there. So that's it touches when the point it touches the efficient frontier for the where we have the efficient portfolio. So that's where we have the RM. So that's the risk that we so that we can corresponding market return, corresponding return, we can take that from the graph itself. So we have a formula for that. We call this formula capitalized asset pricing model. So derived from this concept. So R is the expected return. If you want, you can write it. R is expected return. So we saw earlier slide, RF is risk-free return. B is the beta factor, the sensitivity of investment return to the industry. Beta factor. RM is the market return. RF is we learn risk-free return. So we have some numbers to substitute and get this expected return. This is simple, just for you to understand. There is something like that. If you want to, do extra and advanced studies on that, you tend to probably learn in deep, very much in deep about this CAPM model, capital asset model, and things like that. A lot of complicated sums as well. Right, just to understand. So R is expected return on security, risk-free return, risk-free rate. Beta is the beta of the security, is the sensitivity of the return of the particular share or the stock. RM the expected return on the market, right? So let's say put it in numbers. It trades on the NYSE, New York Stock Exchange, and its operations are based in the United States. Currently, yield on US 10-year Treasury 2.5%. Then, and the average excess historical annual return for US stocks is 7.5%. The beta of the stock is 1.25, meaning its average return is 1.5 times of the volatile as S&P 500 over the last 5 years. Right. So now give us the expected return on the security. Can you all try to substitute these numbers, plug in these numbers, and get an answer to the answer to the by substituting these numbers to the formula? I'll give you couple of minutes. Can you do it quickly? Just to plug in the numbers, complicated thing. Just to let's see, any one of you have any issues? Let me go and check. So if you have any questions, something that you not clear, put it in the chat box. I try as much as possible before the end of the day. So we come into the end of the lesson, also today's lesson. So you can put it in the chat box, or else you can check the, we send the video also, you can go through it and understand that as well. Right. Hope you right. Let's see what's the answer. Right. So we are going to solve R, right? RF is, you can substitute 2.5%, right? 2.5%. You don't have to put percentage, 2.5%, 2.5. Beta factor is 1.25, right? 1.25. RM is here given 7.5% market return, and RF is again 2.5%, right? So expected return is, so RF is 2.5%, right? Plus 1.25. The difference between 7.5 minus 2.55, right? So 5 should be multiplied by 1.25. So how much is it? 1.25 multiplied by 5%. That is 6.25, right? 6.25 plus 2.5. So total expected return here is 8.75. That's the answer. You got that? You're correct. From that, we are moving into another area. So just before that, I'll wind up. I have a video just to give you what is the kind of understanding of our Warren Buffett's Howie, right?
Warren Buffett, throughout his
investing career has achieved an annual average return of 20.9% compared to the market's average return of 9.9%. Now, this may not sound like much, but if you take into account compound interest, Buffett's cumulative return was 2,404,748% compared to the market's 15,508%. This is all because of compound interest. And I won't be explaining compound interest in this video. What I will be talking about is Warren Buffett's current portfolio. We'll look at some of the stocks that made him rich and the stocks that he has picked to make him rich in the future. So let's just get straight on to Warren Buffett's largest position that he has in any stock, and that is Apple. Remember, this is the portfolio of the investing company that Warren Buffett manages, called Berkshire Hathaway. Apple makes up 23.77% of Berkshire's portfolio, and they own $47 billion worth of Apple stock. Now, I hope that you guys have heard of Apple before. Their products, they're found around the world, and arguably they are the most famous brand in the world. They obviously the company that makes phones, but they don't just do this. They make laptops, watches, iPads. They have a service called iTunes. They make money through a range of key areas. But the main way they make money is through their iPhone sales. Now the question becomes, why did Warren Buffett make the decision to have Apple as his largest position by far in his stock portfolio? And Buffett has talked about why he loves Apple stock before. First, it's because of the amazing product that Apple deliver and the following that they have with their products. Consumers are hooked on Apple devices and they're willing to pay a lot more for an Apple device compared to a device from another brand. And that all comes down to the quality of product and brand name. Buffett calls this Apple's competitive advantage or moat. Second would be the price. When Buffett bought Apple, they were selling at a great price compared to the value of the business. And even today, they're selling for a decent price. Their PE ratio is just 17. It's not as good as what it was when Buffett bought it, but the price is still nice. The second biggest stock in Buffett's portfolio is the largest bank in America, called Bank of America. So Bank of America makes up 12.39% of Buffett's overall portfolio, and the total value of this position is $24.7 billion. Bank of America, I don't really need to go into too much detail with this company. It's pretty obvious what they do. They do the typical things that most banks do: commercial banking, wealth management for individuals, investment banking, risk management, etc. Warren Buffett has been buying Bank of America stock for a good amount of time now. He bought back in 2011 when the bank was struggling after the financial crisis, but even to this day, Warren Buffett has been buying more Bank of America shares. And the main reason behind this is the price. Bank of America is just selling for a really good price at the moment and over the past couple of years. BAC at the time of making this video is selling for a price that is just under $30, and it's bringing in earnings of $2.80 per share. This gives it a PE ratio of just 10.5. which is ridiculously low compared to most stocks. On top of this, BAC pay a nice dividend of 72 cents, which gives it a yield of 2.44%. And this was one of the main reasons why Buffett bought into Bank of America, and that's for its extremely cheap price tag. Wells Fargo, a very similar position to that of Bank of America, comes in as Buffett's third biggest stock at 9.93% of his overall portfolio. Wells Fargo is a provider of banking, mortgage, investing, credit card, and financial services company. I also do not want to talk too much about the stock because the reason why Buffett bought into the stock is very similar to why he owns the Bank of America. He just bought it at a cheap price. Wells Fargo, on a pure earnings to price basis, is actually cheaper than that of Bank of America. If you look at its PE ratio, it's actually under 10, which is very low. Buffett actually owns a couple more bank stocks in his portfolio, and the main reason behind this is a cheap price compared to the value of the company. If you want to learn more about valuing a company, it's one of the things that I teach in my How to Invest course. Link, of course, to that is in the description. Let's move on though. One of Warren Buffett's greatest stock buys to this day is the stock Coca-Cola, and Buffett has said this, that he will never sell a share of Coca-Cola in his lifetime. So Warren Buffett bought Coca-Cola back in 1989, and to be honest, I have no idea how he managed to time this investment so well, but pretty much since he bought Coca-Cola, the stock has shot up like a rocket. I remember reading in a book about Warren Buffett, about one of the reasons why he bought into Coca-Cola stock. This book may have been called The Snowball Effect, I believe. I can't really remember. Anyway, Buffett talked about how he used to collect soda lids as a kid. One of the things that he noticed was he was collecting way more Coca-Cola lids than any other soft drink. And this is just because consumers absolutely love the taste of Coca-Cola. There's just something about that flavor and that fizz that makes it the most popular drink in the world. Warren Buffett knew this was a major advantage that Coke had over other companies, and it's a big reason why he owns so much Coke stock. To this day, it's his fourth largest position at Berkshire Hathaway and makes up 9.4% of his overall portfolio. The value of his position is $18.7 billion. Funny fact, Buffett originally paid $2.50 for his Coke stock. Now the dividend for Coke is $1.56 per year. So his dividend now almost pays off his entire stock purchase price every year. One of the things that I talked about in my previous video is with investing, you want to pick an area that you are good at and then master all of those stocks in that area. One area that Buffett is good at is the banking and financial services area. This brings me on to Buffett's fifth largest position, which is American Express. American Express is a financial services company. These guys mainly do charge and credit card products as well as travel-related services around the world. Now, it's quite funny the way Buffett has been buying into American Express. Basically, whenever American Express is in times of trouble, that's when Buffett, the hero, comes and buys some of their stock. He did this in 1963 when they needed capital, and in the 2008 financial crisis. Buffett is always greedy when everyone else is fearful, and this is one way he buys stocks for huge discounts. Bit of a unfortunate stock that Buffett has owned lately, which is Kraft Heinz, coming in at 5.33% of his portfolio, with Buffett's total position in Kraft being worth $10.6 billion. Now, late, and this is why Buffett has been snapped. But as of recent times, Buffett has changed his mind. Manufacturing industry. He's doing this through the stock General Motors, which he bought in early 2012. But he even recently has been buying more of the stock. In the fourth quarter of 2018, Buffett increased his General Motors position by 37% in that last quarter. And those are 14 of Buffett's biggest stock positions as of 2019. The rest of the stocks in Buffett's portfolio are how to invest like Warren Buffett in the description. But my thoughts have always been this. The best investors legally have to disclose the stocks that they invest in. So why not take advantage of this? Look at the stocks that they're buying.
Analyze the stocks that they own, and then make the decision if you want to own them too. Let's be honest, it's just a smarter way to...
So I think that's the video that I promised you just a while ago. So but basically, what this gentleman was talking about. So what we learned so far, the portfolio is Warren Buffett also, from starting from Apple, then a couple of banks, right? Coca-Cola, General Motors, few other the companies. So he has a portfolio of companies, right? This is his portfolio. So the pet area is banking, and it's this person was telling that he has some expertise in pick and choosing the bank shares, because he knows in and out of the industry. He's confident when to buy, and so always when particular share is doing badly, he goes and buy it, and he's sure that will come up very soon. So he's safe. So that's something that he managed his portfolio. He didn't, like I said, he didn't put all his eggs in one basket. He diversified the risk. By diversifying the risk, yes, diversify the unique risk, but in United States, that kind of undiversified systemic risk is relatively low when compared to Sri Lanka. So, but it's a very investor-friendly countries, so they can actually confidently do their own business. So that's a different scenario altogether. Since we can't compare Sri Lankan context to the USA context, or any other country. So I think that gives you an idea. So the expected return that we have calculated with CAPM model, so that gives you an understanding. So when there are so many assets, shares, that's how you calculate the expected return. We are expecting a certain return, you have a percentage of total investment, so you get an expected return. So that's the reason why we have actually taught you that CAPM model. So you probably know the published data, like Treasury bill rates and all. So market returns, those details you need to go into industries and get and do your own study. So this is something that you master, when you are in the industry, stock market and brokers, dealers, that kind of if you are doing a role like this, that you need to be top of this game. So industry trends, you should be able to thorough about these calculations. What does it mean? And there are so many ratios. P ratio, you would heard of it. So many ratios that you need to master. So just here touching certain things, it is much more deeper. I'm just giving you some flavor of what is investment and what is stock market and equity market and all. So one slide, last slide for today. So again, to finish this industry, stock market. So this financial market, particularly the stock market, we talk about three types of efficiencies. Three types of efficiencies with regard to our ability to predict the price of a share to near accurate level, right? So there are weak form of efficiency, we call it weak. There are three categories: weak form of efficiency, semi-strong form of efficiency, strong form of efficiency. Those are the three categories. In the weak form of efficiency, our ability to predict the price of a share. We know now let's say a dialogue share is 10 rupees. So can we predict the price of the share another 1 year's time, whether it is going to increase to 12 or going down to 12? So weak form of efficiency, so very little chance we are getting it right, if you use that method. A semi-strong form of efficiency, if you use that method, there is a 50-50 chance you are getting it right. But if you have strong form of efficiency, you have a very good chance of predicting that price accurately, right? So weak form of efficiency, what we are doing is you are using a graphical mode, right? You day one, so from 1 to, so let's say 365 days now. So let's say 5 days working days, 50 weeks, so we have 250 days. You graphically plot the price of the share in each of the working day, and you can after about 6 months you can use that graph trend and predict the price, right? But all of a sudden there can be so you predict the price after 6 months, the price of the year, 1 year later. But in between there is a terrorist bomb attack or something like that, that will go down. So we can't predict in a trend analysis the share market price in the best possible way. So that is why we call it that kind of line trend analysis is a weak form of historical trend analysis is weak form of efficiency. It doesn't have a very efficient level in predicting prices. There is again semi-strong form of efficiency. We use that similarly market prices, historical analysis, and also publicly available documents. We refer their annual report and see chairman's statement, and again CEO statement. We go through the financial analysis, financial P&L, how strong the balance sheet, analyze the given ratios, and we as experts we do our own analysis and see where this company is heading and what their leaders, their strategies and things like that. And then we try to integrate all these information, assimilate, and look at and predict the price. So then you, in addition to this trend analysis, you have some additional information to support that. So if there is a possibility you can get it right? Again, it is not very spot on kind of a thing. Can be, you can get close to it, right? It's again we call it not 100% efficient method. No, it is called semi-strong form of efficiency, right? So then the next one, strong form of efficiency, where we use the trend analysis, again the annual reports, maybe interim reports, the quarterly these newspapers. Every stock market listed company need to publish their balance sheet, P&L, and other financial data. To use that, analyze, and then also we have some can peep into the CEO's room, maybe a media person or something like that. You can get an interview from the CEO and have an interactive session, and we can get some idea of next 6 months what is going to do, what that office strategies, what is going to get translate into financial returns or reflect in the financial performance. So person who only do with the trend analysis and who reads annual report will not have access to this information. So if that person has a better chance of predicting. So if they have a good project, like a good marketing plan, which is going to penetrate the market and increase the market share kind of a thing, if you have that kind of feeling, you predict that 10 rupees kind likely to go 12 rupees. I can, you can buy at 10 rupees now. It is going to 12 rupees. Then I can sell it and get my money back, right? So I can get, some return. So that kind of a scenario where you look at market analysis, so trend analysis, historical data, private data, public and private both data. So then you have a better chance of predicting the price. So the efficiency level we actually determine depending on the how, to what extent you can accurately predict the price of a share. So that's I think with that I think we should conclude today's lesson. So next week I think we will start on another area of this financial market, another very important area, foreign exchange market. So how that so we talk about what exactly our foreign exchange crisis is all about also next week, and also So next week we'll basically discussing the bulk of the course. So the following week, kind of the covering up the cover the entire syllabus and go do some revisions as well. So hope everything is clear. I'll wait for another 5 minutes. If you have any questions, you can put it in chat and I'll explain it. So if not, so that's the end of the session. So hope we'll stay safe. So meet you soon next week. Right. Thank you very much. Thanks. Right. Someone is asking, sir, can you please explain beta? Beta. So now we talk. We with CAPM model. We try to assess the return of the entire portfolio. Let's say we last watched the Buffett's portfolio. No, the portfolio's entire return, right? So there can be certain shares, maybe Apple or something like that. So their price sensitivity is very high, right? It can go up, right? Go up and down. So the return is very sensitive to when compared to the overall return. The Apple's return is very rapidly changing. So it is very sensitive, right? Very responding. So as a result, its beta factor is relatively higher, right? So we are expecting a higher return from that kind of a share. So that's the beta. So it is very detailed. So if you really want to study, we need to, there are a lot of other concepts that you need to study also. Basically, it's the sensitivity of one share's return to overall portfolio level return, sensitivity of that. So if it is more sensitive, the beta is relatively higher. Which is less sensitive, the beta factor is relatively low, meaning it less than 1. If it is highly sensitive, it is 1.25, 1.35, or 1.5 or something like that. That's a kind of understanding that you should have. Thanks. Hope it is clear.